If a client is stressing about the yield so much, typically it's probably too late.
If that's the case for your end goal, why do you stress about it so much at the start on the way to your end goal?
Cash is not king in this case.
Cash flow ain't king in this case. We might as well end the episode now. I just realized,
People think about yields and they only think about that number and they go, wow, 0.5%, 1%, but they don't consider the cash flow side of things, which actually doesn't have a huge impact.
Capital growth is king, like in property investing, especially in the early stages while you're trying to scale.
People are talking about property and residential property as a means to retire. But welcome to another episode of the Property Nerds podcast. I'm joined by co-hosts Adrian Lee and Jack Fouracre from Fouracre Financial. And today we're talking about a very, very important one, but it does feel like a bit of a back to basics, but it's not, because we're going to make the basics really unpack into this world of complexity. Because if you do that, you can understand exactly how far people are from the basics when it looks at this scenario today that we're going to cover off. And what it is rental yield impact on borrowing capacity.
Nerd alert! Property Nerds, the home for data-driven property investors, where we uncover Australia's hot and cold markets, latest headlines and trends.
Adrian, you hear it often. I want a higher yield because it's going to help me with cash flow, going to help me with borrowing capacity. Let's talk about this borrowing capacity on yield, and firstly, why you hear that often, and is it a good thing to target? Let's talk about it at a high level. What are your thoughts?
Yeah. Look, I think when people think about, what you've said, hey, let's maximize rental yield so that we can get the max amount of cash flow, which will give us the max amount of income, increase borrowing capacity. It's a very logical flow of thinking. But then when you break it down, there's so many different trade-offs that, like you said, it's going from the basics to actually there's a lot of nuance between it. And, in theory, it makes sense because you get better cash flow, you have better income, borrowing capacity increases, but what are the trade-offs that you have to consider? And when you think about the trade-offs, it comes down to, how many markets actually have this yield? What are the opportunities that you're potentially missing out on if you are chasing this yield? Is it even worth it because you're extra, $20, $50 of rent and you taking an extra couple months of searching for the property? You might have lost the 10, 20, 30,000 as well.
That's massive, yeah.
And that could have been the difference in your rent for the 30 years that you've owned it, right? So sometimes it makes sense when you say it and you think about it.
Logically, it makes sense.
Logically, it makes sense.
Logic ain't always logic when you break it down.
Yeah. And then there's all these nuances where you go, actually, maybe I should consider something with a little bit of a lower yield. Now, the one thing that, of course, we can break down is borrowing capacity. Everyone talks about borrowing capacity as that preservation thing that you need to preserve it as much as possible.
Is that true, Jack? Do you need yield really to be this X factor for you to even just get decent borrowing capacity? Or
So often what I see is if a client is stressing about the yield so much and they really need a high yield for a particular purchase for their borrowing capacity, typically it's probably too late for them because they should have addressed the borrowing power issues earlier in the piece.
Is that because it doesn't make a difference?
Well, it doesn't really make that much of a difference, man. Like 0.5%, 1% here or there, it doesn't translate to these massive numbers that people may think.
Let's try and do some quick math. Because it's going to be simple.
Math with a triple F.
With a math, right? Just because it's calculators, no. This is the most savvy borrowing capacity tool out. The calc on the iPhone. But if we take a 750K purchase and we say we take a 4% yield, that is a rent amount of 30,000. But if we make that yield at 750K 4.5, a big 0.5% jump, that's 33,750. So it's $3,750. So, Jack, how much do the banks shade off rent usually?
Call it 90.
90. So we'll go 10% off. So we'll go 90. And we're being generous because sometimes it can be lower than 90, right?
Yeah, it's quite
80?
common to do it at 90. Well, most lenders are at 80. Okay. But the amount of lenders that are shading it to 90 is increasing by the week.
And then debt to income ratio. So this is a multiple of this income that gets added to your borrowing capacity. What should we use? 6? 5? Yeah. Okay, 6. Drum roll. A whopping $20,000, 250 in borrowing capacity increase.
It's a difference between a good negotiator and not.
Yeah, but does your game change, Adrian, if a customer comes up and goes, you know what, I need that yield. So instead of 750, we can get to 770.
Not really. And I think that's where, a lot of people might think logical assumption is, hey, I've got $20,000 more, which is, don't get me wrong, it's a decent amount that you could increase in terms of purchase price. And maybe you increase, I don't know, properties coming along and there's that one that sits a little bit above that amount.
Right.
But if you've just excluded 5 or 10 different markets because of the yield versus that one property that you could have gotten.
True, because this is the flip side. So we talked about borrowing capacity. As we can see, it's not a major impact by having a 0.5% higher yield. It was only, $20,000 more in borrowing cap. But the big thing is, if you have 4% yields here, like top of your head, you don't have to name the cities, but how many cities in our current buying markets that we're looking at suit a 4% yield at 750?
I'd say quite a few, probably 10 or
10?
so. Yeah.
But then if you move that to 4.5 from that same
Probably
750,
cut it less than half, I reckon.
so you lose 5 markets. Now, if a typical time frame, by the way, most Aussies are refreshing their pre-approval, a couple of times, 1 or 2 times, if they don't have professional support. Pre-approval refresh at 3 months becomes 6 months all of a sudden. If we're looking at 6 months as a normal way to do it, and then you go 2 to 4 months with a certain professional, and now all of a sudden with the 2 to 4 months with a professional, that number is about to be that 4 to 6 months simply because you went from 10 markets to 5. That's a game changer. It's 0.5% to feel good about 20K more borrowing, but then it actually cut half your cities because you weren't open to having 20K less borrowing. Or if we put borrowing aside, the actual rental income that was higher was $3,750. So you divide that by 52 is $72 a week. And it's income. Income is taxed. So, in this case, gearing, but that's $50 a week probably after tax. So for $50 a week, you're willing to add multiple months to your search, half the cities that you choose from, and all for the hope that you think it helps your borrowing capacity, but it only increases at circa 20K. And you now lose all this money on the upside of the gain too. Because if you took 2-3 months longer to search in markets that we can forecast hotspot markets in, or high growth markets, and they're doing 1% a month, that's a circa $7,500 per month that you're losing out in growth from the purpose of trying to chase $50 a week in cash flow. That's wild.
Cash is not king in this case.
Cash flow ain't king in this case. We might as well end the episode now. I just realized, holy shit, just don't do that. Punchline, finish it here. Don't do that. Please don't do that.
No, I had a client send us a property in Broken Hill or something. It was like 250. It was like an 8% yield. I was like, mate, why? That rental income is not going to move the needle for you the way you think. And actually, capital growth is king, like in property investing, especially in the early stages while you're trying to scale. So it's not a...
Well, you've touched on a really good point, which is people are talking about property and residential property as a means to retire. But residential property is a means to build wealth. And if you're happy with an inefficient portfolio, 3 to 4 residential properties can still get you a 6-figure passive income inefficiently, but it can get you that. And if you want to make it efficiently, it's unlikely residential property gets you the passive income to the highest dollar usage it could be when you end up debt-free and the value's here and the rent's here. And so, you can use that money in any way you want. Go in other vehicles, go to commercial, exit, downsize, whatever you want to do. But the main thing is, if that's the case for your end goal, why do you stress about it so much at the start on the way to your end goal? You know what I mean? Tune into our podcast for real-life case studies, the latest data, and even expert guidance on residential and commercial investing. It's everything you need to stay sharp, straight from the field. Make sure to like and subscribe to get insights that only we have. And now, let's get back into the show. Adrian, when it comes to scenarios for these yields, what do you think has created this high yield, high growth, high comfort, thought that every property needs to have this, everything on it? And if someone does have a smaller budget, maybe the yields do elevate, but do yields stick with the budget as the budgets go higher? What happens in those scenarios?
Yeah, so I guess to break it down, the usual thing that happens when it comes to markets or properties increasing in price is yield compression, which is the higher the property increases in price, usually price growth outpaces rental growth, which means that yields compress. Now, this is very normal. Like, this happens in every single market. If we talk about the most expensive places in Sydney, you're talking, 1-2% yields. So it's normal for that to happen. I guess the main thing to, commonly consider, and we actually did a bit of an exercise around this of comparing like 400K assets to 800K assets, dropping the yields. And I think the easy way to summarize it is people think about yields and they only think about that number and they go, wow, 0.5%, 1%. But they don't consider the cash flow side of things, which actually doesn't have a huge impact.
Yeah.
When you think about the fixed costs of owning properties, like your council, your water, insurance, all of these things, they don't scale 1-to-1 with property prices increasing.
Boom. That's a big point. If you take two 500K houses at higher yields in comparison to $1 million house, the $1 million house still has the same council rates notice, and it might not be that much more. It says the same water bill, and again, it might not be that much more. And it also has one insurance policy, might be a little bit more, but not typically that much more. But yes, you get the two higher rents at the higher yield on the $1 million when you have 500K properties, maybe say a 5% versus a 3%. But that 2% now has to not only, be higher completely, but now it's not higher completely, because if you look at it, it's now two sets of rates, two sets of water bill, two sets of insurance policy, two sets of maintenance on the kitchen, two sets of maintenance on the roof, two sets of bathroom maintenances, two sets of letting fee, two sets of routine inspections, two sets of vacancy, and that can all happen. Now, it's not to say that you're doing a bad decision by purchasing a 500 to 600K property. My last purchase for my own portfolio was 660K. But the idea here is that, like, if you have the $1 million, cutting it up isn't always the strategy that makes the most sense if you do look at it holistically with all the real numbers.
Yeah. There's multiple things that you can look at when it comes to the budget. And the thing I think that also we get caught up in is we're comparing the $1 million budget with the 500K budget. And you're comparing two sides of things and the extremes. But there is the middle ground, right? Which is what we're kind of talking of, which is, you can stretch a little bit. Sure, prices go up a little bit, yields compress a little bit, but that's usually that middle ground where you don't have to compromise on both things. You don't have to go to one singular market that is in that 500K price point and the 4.5% yield. So there's the compromise between the both where you get the best of both worlds as well.
I think there's a bit of a hangover from the COVID period because I've worked with a lot of buyers agents over the years, and during COVID when we had 2% rates, like the marketing play was like, and the sales funnel was fully based around cash flow.
Positive cash flow.
Positive cash flow, this, blah, blah, blah. Like, because literally you buy a 500K property, a couple $100 a week positive. And they would use this in their sales technique. And then as the rates went up, I started to like speak to these same buyers agents, and they're talking about, we might have to change the way we're selling because like the cash flow thing, it's not really, you can't buy positive cash flow at 80% now. So yeah, I think it's still a bit of maybe there's a misconception from all of that during COVID, and clients just aren't aware that it's not a thing anymore.
It's a really good point you say that, because the amount of people that, thank you, you're welcome. That's actually a really good point. You got a really good point there, because, it's the same thing when it comes to people going, I got an 800K budget. What can I get in Sydney? Wait, why? Oh, but I got a 600K budget. Can we get anything in Sydney?
One bedroom unit, studio.
Homebush West. But it clicks. Why are they saying that? Well, they're coming to a professional, they're open to buy nationally, but they're still saying that. I get it now. It's because they only experienced Sydney from 2011 to 2017. And I've now had this conversation. I just realized there's a common theme here too. Me being Indian, I have many Indian clients too, but we have clients from all over. And I noticed from the Southeast Asian clients and just the Asian clients that had migrated to Australia between 2010 to 2015, that client base bought their homes during that time. Yeah. And so when they bought their homes during that time, they don't have any history of data before that. They don't have any understanding of Brisbane and Adelaide and outperforming Sydney and Melbourne between 2000 and 2010. They don't have any data of Bundaberg being one of the top performers in the country between 2000 and 2006. They don't have all this data. And so for them, their only knowledge is, wow, I got a better life in another part of the world. I got a great job. I've been saving hard, working hard, and I saved and I bought my home for my family. And it was a lot of blood, sweat, and tears. And then all of a sudden, whoa, our money's doubled? You're telling me I can invest now? This is the greatest gift ever. New country, great life, new jobs, safety, weather, health, and then you've doubled your money too. Like this is, and imagine them spreading that out to like everyone. Sydney's the best, Sydney's the best. And then all of a sudden, everything is about how do I get another Sydney place, another investment in Sydney. And it just doesn't, there's no data. And I spoke to them about that. I'm like, they're like, you know what? That's all we know.
Yeah.
Sydney's the best in our eyes because of that. And so it's so true because that whole, if that was the moment, it carries on. It's like a lag effect in the mind. It's just sitting there. It's like positive cash flow. Well, look, who knows? Maybe we do return to positive cash flow again with the way rates have come down. It could, but for now, we've got to assume it's not. And what you are today is what you are today. So then based on that, Adrian, this is the part where people's portfolio planning that you and the team do a lot of, visualization on. There's a curve. And this curve of passive income is this line like this for a target because inflation makes the target higher.
Yeah.
And so today's 100K in about 15 years might be, today's 125K in about 15 years might be a 195K target that you got to aim for. And so that's inflation doing its dirty deed, right? But then the cash flow, we have a line called zero and the cash flow is a blue color and the cash flow starts negative, but then the curve catches up and it goes beyond zero and goes to positive and eventually catches your target.
Yeah.
How has that conversation shifted and how do people look at that? And what are some of the impacts you notice that has on a property buyer and investor's mind when they see that negative to begin with to even get going later on?
I think previously a lot of people weren't as receptive to it because we were so used to that environment. Low rates, yields were stronger, everything's starting off with positive cash flow, whereas now we are in this environment where everything is going to be negative. Even if you have a 20% deposit and things like that, we're going to start off negative. But I think a lot of investors have understood that that's the environment we're in right now.
Yeah.
And I think it's a good point that you brought up because it's shifting with the times. Previously, and as we kind of know, growth and cash flow aren't correlated.
Yeah.
You can find places that, at least back then, high growth, high cash flow. But if we're thinking about the reality or the environment right now, it's probably arguable that some of the best places do have slightly lower yields or not the best yields, which is why we're making that argument of, hey, you're limiting your options in terms of markets if we are chasing this yield. And what that means is if we are looking for the best growth, because that's what we're doing, we're trying to build wealth, we're trying to build the portfolio size, we do have to have that little bit of sacrifice in terms of negative cash flow at the start. But it does come around, as you've mentioned. It comes up to hit neutral, positive cash flow with time as you pay down debt, as rents increase, as rates potentially decrease as well. And then it gets you to that goal. So I think it's becoming a lot more normalized now. A lot of people understand that's a sacrifice that you have to make to build up and get the best results for your portfolio later on.
Absolutely. Temporary sacrifice, long-term gain.
In short, $5,000 a year in additional rental income isn't as good as $70,000 extra of capital growth.
That's it. And if you can get that growth because you had more cities to choose from, you had a faster purchasing time, you had more properties that you were open to, and your budget worked harder for you because you had a bigger budget to do multiple things, game changer. So that's the yield part and how it's not really a big impactor on scaling a portfolio as it once used to be when it comes to residential property and building wealth. The bigger drivers are actually going to be three things. Number one is your mindset around how long you're willing to hold on to negative gearing properties before that chart, like we said, turns from negative to positive. Because once you can see the other side, you can be like, that's my goal to freedom. Number two is how much actually you are in terms of how good you are as a saver. Like that's the thing, right? We know that today's market requires 1 to 2K negative cash flow per month, depending on which property, but most are sitting around there and some higher, some lower, depending on your budget. But if you're at 1 to 2K, if you're saving 3 to 5K, mentally that doesn't hurt you. But if you're saving 2K a month and you go, I want to get into property investing, and that takes all of it, and you're going to be deflated because one property took all of it in this time, you might not build a portfolio. So how you are as a saver also helps. And then the third part, hardest one to move, but it's a key one to think, is property is more on your strategy, your team around you, and your income. So it's not going to be the yield. Your household income having a $20,000 bonus at 6 times debt to income ratio is 180K. That bonus that you worked hard for, that business that you scaled, that promotion that you got, the job that you changed, the pay rise that you did, like these things make a bigger impact than 4 to 5% yield or 4 to 4.5% yield. That's the game changer. And so that's the key part here. And like when you're building out your portfolio, you don't want to be so stuck on yield. And that's the key for today. Now, Jack, I want to shift to another topic though, because yield is one thing, but when it comes to scaling a portfolio, we've noticed other entities too. And with yield, we've noticed that it's not as obviously big of a scaling part to the journey, but other entities we've seen popping up all the time, especially in recent times, has been SMSF. Now, I know we can go to a whole other topic on this, and we will in future episodes, but there's something in particular that's come out now more from a timeliness matter that we're like, oh, this is very interesting. Now, before we jump into it, we need to get your advice when it comes to setting up an SMSF, see if it's the right one for you, speak to a qualified and licensed professional. But if you have gone on that journey and you have set it up and now you're looking at your lending options, what's come up of late that's a bit of a game changer?
Yeah, so as more and more time goes on, more lenders are coming into that market. They want a piece of the pie because it is becoming really popular, especially when rates went up. People were trying to find other ways to borrow and they realized they had a separate borrowing within an SMSF. So yeah, as more lenders come into that, there's more competition, more, promotions and policy niches. So we could always go up to 90% LVR in SMSF and 85% in SMSF, but we're talking 3% of the purchase price is risk fees, right? So if you're buying a 600K property, 18K risk fee, bang.
That's massive.
Right? So that's would turn a lot of clients off and there was a lot of restrictions, but recently the lenders came in and they're offering 90%, no risk fee.
No risk fee.
No
So that's
LMI, no risk fee,
circa
just straight up.
$20,000 saving right there.
Yeah. And it's not a lot of restrictions.
And are the
Pretty good.
rates wildly more?
Not crazy, man. Like it's like any LMI waiver. If you look at the difference that you pay in rate versus what you would pay in LMI, it's actually a no-brainer. And the fact that you can refinance it at a lower rate within 18 months if on a good purchase, it is actually a no-brainer.
And who knows, your financial planner might actually be happier. And what I mean by that is that if you're a high income earner or an earner as a couple and your contribution is there covering that high leverage, in their opinion, they're like, oh, cool. So you got your property taste in this fund. You've got greater leverage. There's more money left over in your fund due to the higher loan to value ratio and no risk fee. Now we can diversify your fund in more ways because you've got more cash left over.
Yeah.
Right? Now, obviously, your financial planner will let you know of that if that makes sense for you or not from an advice perspective. But that's a game changer when it comes to borrowing because now you're not all property. Like you have money in property, but you also have money left over you can consider for other things a little bit more than you normally would with SMSF. So, Jack, when it comes to people with SMSFs, either just setting it up or looking into it, how can they get in touch with you on the team?
FouracreFinancial.com.au or Mortgage Freeman on Instagram.
There you go, Mortgage Freeman. But overall, we mentioned today's topic on yield. It's a really important one to mention. It's because we see it so often, and that's why these topics come to light. And so more important than the yield, reach out to the team at Fouracre Financial because Fouracre Financial's team, when it comes to solving lending scaling, is actually solving it in the way that it should be, which is strategy, banking options, income, right? And if you look at that, the income part is the part you can control, but at least you can reverse engineer what you need. A target and a goal starts with like reverse engineering. And then when it comes to strategy and bank options, that's the dial movers, not the 5 yield from a 4.5, the 4 to a 4.5 and more. And from that perspective, thank you so much for tuning in to another episode of the Property Nerds podcast, talking rental yields, talking cash flow, the impact, how it's not as much as we think, but also for today's episode, that new learning on the SMSF side is a big game changer. So if you want to reach out to a team and we can actually help you scale a portfolio in that way with staying up to date with policies, don't forget to reach out to fouracrefinancial.com.au. And if you're looking to grow your portfolio, our team at investorkit.com.au can help you take it to new heights. Thank you so much for tuning into this podcast. To hear more like this and to help us spread the word, don't forget to leave us a rating and follow along for our next episode.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Game over.